In part one of 3% monthly profits possible, we delved into the question from Max R. Based on your experience, is there a way for an option trader to get 3% monthly profit on the whole portfolio consistently in any market conditions? In part one, we discussed move with the market. And we started off by polling the audience to gauge expected monthly return, which strategies they used the most, then showed why, in a market like 2022, investors needed to move with the market. Strategy shift was necessary when the market turned from bull to bear and from bear to bull. What were those poll results from part one? Of the audience that attended, the realized and expected monthly return, 46% of the audience said their target was 1 to 2% per month. Another 23% said 2 to 3% per month, 15% said 4 to 6, and 8% were more than 6%. In addition to that, 8% said under 1% per month. And what is the go-to strategy for the bulk of their portfolios? Well, the conservative income strategies, covered calls and naked puts, 15%, with married puts and collars being 38%. Now, 23% of the audience said the bulk of their portfolio was credit spreads and debit spreads, as well as buying options, diagonal spreads or calendar spreads, poor man's covered calls. No one said that was the bulk of their portfolio. A question came in after that poll during the presentation of why are people settling for 1 or 2% return? Are they settling or are they succeeding? 53% of that audience total said they were using covered calls, naked puts, married puts, and collars. And 46% total said they were realizing and expecting a 1 to 2% return per month. This relates to a question I had on a coaching session that week. What are your suggestions on the best conservative income investing in this environment? In order for us, the best conservative income investments are married puts following the rules in the blueprint, standard collar positions, in the money covered calls for better protection and higher probability, and parity trade out of the money cash secured puts. All four of those, though, are bullish strategies. Could they even be profitable in a trading year like 2022? Were bearish strategies even successful? Well, in part one, we showed how neither high probability bear call credit spreads or high probability bull put credit spreads would have been profitable. Neither would have iron condors. But by changing direction, moving from bull to bear with the help of the market sentiment tool, the 3% profit per month goal was achieved. But because of the high risk of those strategies, where you can lose 100% for only a 9 or 7% drawdown in the market, we only used 10% of the total portfolio, so we didn't fall into the trap of the lie of leverage. The conservative income strategies mentioned require stock purchase or using cash secured puts for the full amount of the put strike price. We will need to allocate a higher amount due to the higher cost of those positions. Similar to the test we did in part one, we're going to take a $100,000 account, but because of the higher cost, we're going to allocate 50% to cash secured puts that are out of the money. This would be a parity trade, of course, to in the money covered calls. We're going to take a look at the backtest performance over the first 8 months of 2022, as we did with the bull puts and the bear calls in part one. We're just going to use a 1 month out basic cash secured put approach. We're going to look for at least 10% out of the money for a volatile market. I'm going to try to look for positions that have an implied volatility of less than 1. We don't want too high of an implied volatility, although that would give a better premium, but it has a better chance of moving against us drastically. We're also, as always, using the patented search tool in PowerOptions, put in basic stock criteria. I'm going to look for mid-cap or higher, 750,000 average volume per day on the stock, positive earnings per share growth, stocks above their 20-day or 50-day moving average, and, of course, avoid earnings. And we're going to sort the results by the highest naked yield, in a sense, to look for the best bang for the buck. In the 8-month period, starting off on December 19th, 2021, so we can get the first January series in, We looked at the 10% out of the money, allocating $50,000 to the backtest. The ending cash amount after 8 months was $55,401. This is a 10.8% return, even in 2022, going 10% out of the money. That comes out to roughly 1.35% per month, the 1 to 2% range. Out of 29 trades, there was an 83% success rate, and only 5 stops were hit. The average return on the winners was close to the 3% target at 2.8%. The average loss on those 5 losers was 4.2%. We looked to open 4 trades per each cycle. Well, if that was successful, why not go higher? Go only 7% out of the money instead of 10%, targeting a 3% monthly return minimum. Well, in this case, we ended up with $53,009, only a 6% return, or 0.75% per month. And the main reason why is because the volatile market, out of 33 trades, the win percentage was only 61%. We did have an average return of the target of 3%, but the 13 losses out of the 33 trades with an average loss of 2.7 really brought down the profits and the target goals. Would a higher return negate the losses? Well, if we went only 5% out of the money, targeting a 4% yield or higher, we do see a similar return to 10% out of the money. Ending cash on hand was $55,144, or 10.3% for the 8-month period, roughly about 1.3% per month. But in 28 trades, the success rate was only 57%. Too many stops were hit because we were too close to the current stock price. The average return on the winners was 4%, but we did average on the losses 2%. But again, the losses were 43% of the time. That's not the rate of success we need for a conservative income strategy. If we took out the stop, could we have a better win rate? In this case, the same 5% out of the money was run. We increased the win percentage to 68%. But the ending amount is only $53,727, or 7.5% over an 8-month period. Although the success rate increased, the average return on the losses increased to 6.2%, which negated any of the previous gains we saw, lowering our average return on the position. This illustrates the importance, of course, of using stops in these strategies for management or just exiting the position. Let's table that. Trade results for out-of-the-money naked puts starting December 19th, 2021 through September 1st, 2022. Remember, we're starting with $50,000 of the total $100,000 account. The 10% out of the money ended up with a 10.8% return, or 1.35% per month, right in the wheelhouse of the 1 to 2%. A good success rate of 83%, 29 total trades made. Average return on the winners was 2.8%, and the average loss on the losers was minus 4.2%. 7% out of the money, targeting a higher return. Well, we have a lower 8-month return of only 6%, or 0.75% per month. A terrible success rate with the volatility, the flux of the market up and down in 2022, only 61% success rate. We did see the average win of 3% in the targets Max was looking for, but the average losses of 2.7%, and being right only 61% of the time, negated the expected profits. Going more aggressive, just 5% out of the money, higher return. Well, we did see close to the 10.3%, or 1.3% per month that we saw with 10% out of the money, but this only had a 57% success rate. Good return, average winners of 4.1% on the 28 trades, the 16 that were successful, I should say, but taking a loss of 2% on the other 12 trades of the 28 that were made. And if we took out the stop and just let the positions go, we lower the return to only 7.5%, 0.94% per month. We increase the success rate of the 5% out of the money from 57% to 68%. We slightly increased the average win to 4.5. We more than triple the average loss to 6.2% on the 9 trades that moved against us. Because there was no stop in place, larger losses were realized. In the money covered calls, with the same stock criteria and the same percentage in the money, of course, had near identical results, as they are parity trades of one another. Well, how does this all apply, though? MaxR was looking for strategies for 3% per month consistently in all market conditions. Yes, the patented search tools and PowerOptions will find out-of-the-money naked puts or in-the-money covered calls with the 3% return. But the 1 to 2% target for conservative income strategies was attainable. But we saw that targeting higher results, having less probability, less range out of the money to get the desired turn, did not typically result in the desired outcomes. And this is why we say that the 1 to 2% target range for conservative income strategies is succeeding. It's not settling. But that was 2022. It's been a very hectic market, and it still is. Couldn't the goals be achieved in a better market condition? In 2017, we essentially were lower left to upper right with a few hiccups in there, similar to 2019 with a little bit more hiccups going in those situations. Couldn't we realize that 3% return for out-of-the-money naked puts or in-the-money covered calls in up markets? Let's take that same 10% out-of-the-money screen we ran for 2022. And over the course of 12 months here, we see that the return is 1.8% on the portfolio. We are close to average wins of 2.9%, but only 4 trades were made in that 12-month period. Why did we only see 4 trades over 12 months using the 10% out of the money? And it's because we were looking for a minimum naked yield of around 1 to 1.5%, being 10% out of the money. In 2017, the average VIX, the volatility index, was only around 12, 11.5 to 12, maybe 13. In 2022, the average for the volatility index was around 26. Volatility, the double-edged sword. Better premium, but a more volatile market, which is going to hinder the success rate and available trades for conservative income strategies. With the 7% out of the money search we used for 2022, looking for the minimum 3% return, only 4 trades were matched through the entire 12 months of 2017. The 5% out of the money naked put, looking for the minimum 4% return with VIX around 12 to 13 on average, only 1 trade was made. In part 1, we reinforced the concept of moving with the market and the tools that you can use to help you with that. But now we get a chance to illustrate know the market. What is available currently in 2022, maybe available in 2020 or even parts of 2021, was not have seen positions that were available in the same criteria in other low volatility conditions. So let's run that 2017 again. Let's take that 10% out of the money, but remove the return limitation. Now, we really only did this scan from about March of 2017 to January of 2018, so it's about 8 months total. But that 10% out of the money resulted in a 7% return. Remember, not screening for a total return at all, no minimum return required. And it came out over that 8-month period to about 0.58 per month. Wins and losses, 93% success rate for 29 trades, the average return on the wins of 1.4%. Half of what we saw with the average return on wins, which is about 2.9% for 2022. And the average return on loss is about the same, about 2%. And why is the return so much lower? And it's because the volatility was not allowing the targets to be achieved with this range out of the money. The overall return is below the 1 to 2% target, but again, volatility is playing its role. Let's go with the bigger one. What I mean by that, of course, is less out of the money, 5% only in an upward market, looking for a lower return though. Instead of looking for 4%, we're going to look for 2% minimum return, again over 8 months. Even though the market was lower left to upper right, the more aggressive 5% out of the money only saw a 63% success rate with the stop in place. Out of 40 trades, 15 losses were hit and only 25 wins. The average return on the winners was 1.8%, in the 1 to 2% range, but because of that low success rate, the end return was a loss of 2.7%. $50,000 would have dropped down to $48,658. Now let's just take a comparison. Basic SPY, keeping the same range out of the money, 4 to 7%. Well, the $50,000 would have moved up to $51,047, again, roughly over that 8-month period from 3/1/2017 to 1/20/2018. It was a 100% success rate over that time period with 7 total trades made. There were only 7 trades made because I got hindered by the June and September quarterlies in the backtest. Instead of just going from standard May expiration to June expiration, it went to June 30th. And instead of going from August expiration to standard September, it went to September 30th. So there were 2 cycles that were lost. But look at this. The average return on the winners with a 100% success rate was only 0.3%. And that's because SPY naturally has a lower volatility than the markets. Even though the VIX average was around maybe 12 or so, the average implied volatility of SPY during 2017 was probably around 9 or 10 even, just a little bit lower, but it does impact the average return. So isn't this presentation about looking for 3% returns in all market conditions consistently? Well, as we saw, many out-of-the-money cash secured puts and in-the-money covered calls can be found that are 10% out of the money, in the money, with a potential 3% return due to the increase in volatility, almost double, really more than double of what it was on average in 2017. Simply looking for the desired or expected return does not mean you'll achieve these results. More aggressive positions with more aggressive expectations will have a lower probability of long-term success. Of course, what about different criteria? What about using different stops? Well, we've already done that for you essentially on PowerOptions with the monthly and weekly picks of the day for covered calls and naked puts. It's based on Ernie's 75 to 80 different iterations of criteria: out of the money, in the money, at the money, avoiding earnings, not avoiding earnings, different stock criteria, underlying, and more. And he ran those various iterations and he found the criteria that matched and had the highest return over different testing periods. That's why we offer those picks of the day as a good starting point and test it as well. But let's move on. 2019, would that have been better? We still had some hiccups in here, but we were lower left to upper right. Bad August to September. I remember that one. I think I was at the beach actually when that first decline started around August 2nd or August 3rd. And then we had another decline in October, but ramped up right after that. The average volatility of the VIX index in 2019 was more around 16 or 16.5. So we should have been able to do better. Let's take that preferred monthly picks of the day. It's similar to the 7% out of the money and similar stock criteria that we used for the previous examples. But Ernie uses a higher stop of around 20%. If the stock falls 20% from the purchase price, he'll usually just exit the position. And he uses a different allocation. He was essentially putting into 2 trades or 50% of the full $100,000 portfolio. But we can extrapolate that into $50,000 very easily. What did we have in 2019? We see a 17.4% return, or 1.45% per month. 88% success rate with 24 total trades made. He's only allowing 2, where in our previous screens we were allowing for 4. The average return from the winners was about 2.9%, and the average loss on the losers, only the 3 times there were losses, was only 8.5%. That's still relatively high, but with an 88% success rate, we're still able to achieve the 1 to 2% we're looking for with conservative income strategies. Extrapolating out, instead of a profit of $17,448 on $100,000, this would result in a profit of $8,724 using only the $50,000 we mentioned before, still a 17.4% return over 12 months, or average of 1.5% per month. Let's just call it that. Well, if that worked and it was looking for 6% out of the money or a little bit more, what about the 5% out of the money range? Again, not that good at all. More aggressive, targeting the higher return, almost make that with the average return for the winners of 2.6%, but it's only a 58% success rate, using a stop of going down 7%. Why only 7? We started 5% out of the money. We're collecting about 2%, so if we stop it at 7%, we still might be seeing a small profit. But unfortunately, it still moved against us too much, near the 3% target, but again, the 21 losses out of 50 trades negated the profits we were expecting with the more aggressive. What if we take out the stop? Use that same criteria, 5% out of the money in a bull market, good average volatility of around 16% or so. Well, now we jump up to an 82% success rate, what we want to see with conservative income strategies in the money covered calls and the out-of-the-money cash secured puts. The average return on winners is close to the 3% at 2.6%. But without the stop in place, the average return for the losses, even though there's only 9 of them, almost triples to 14.4%, negating the gains we would have expected because we weren't as far out of the money, being too aggressive, looking for the higher return, even in a lower volatile market. Now let's take a look at 2019. Ernie's monthly picks of the day, 1 month out naked puts. Ending amount, $58,724, extrapolated off of 100,000. But it's still a 17.4% return, or 1.45 per month, with an 88% success rate. Average return on the winners, 2.9%, close to the 3% expected, but some of the losses there took out the expectation, so we're only about 1.5% per month. Settling or succeeding? Well, if we just did our 10% out of the money, we ended up with $52,796. Now, that's only a 5.6% or 0.5% per month, roughly over the 12-month period. Did have an 80% success rate. Out of 40 trades, we only had 8 losses, but going deeper out of the money, volatility is still lower. The average return on the winners was only 1.6%. The average loss on the losers was 2.9%. Now, we did do 5% out of the money comparison here for SPY. It ended up about the same as our standard 10%, a 5.4% return over 12 months, or 0.45% per month. But it had a 100% success rate with 13 total trades. Less work, less return. The average win on SPY was 0.6% for the 13 winners. That's double of the average return we saw in 2017, with volatility moving up from an average of around 12 to an average of around 16. 5% approach, out of the money, more aggressive, looking for the higher return and using a 7% stop. Well, that portfolio was down 1.2% from $50,000 to $49,419, or a loss of 0.1% per month. Only had a 58% success rate, which killed the expected profits. Yes, the average return on the winners was 2.6%. The average loss on the losers, 42% of the time, was 3.8%. That negated the expectations. Take out the stop. Shouldn't we do better? In this case, no. We dropped down 2.2% total on the portfolio to $48,890. We do increase the success rate to 82%. We only had 9 losses. However, the losses increased to an average of 14.4%, which took more out of the portfolio. Subtle conclusion here, don't mess with the master. As mentioned, the iterations Ernie went through, 75 to 80 for each of the monthly naked put picks of the day, weekly naked put picks of the day, monthly covered call picks of the day, and weekly covered call picks of the day, show us the best return in that market. Is it the 3% per month that Max was asking for? No, but it's matching the 1 to 2% per month that most of the audience said that they were expecting and realizing using conservative income strategies. Now let's break down each one by percentages, the 10% over the years. In 2022, we would have seen a 10.8% return with an 83% success rate, even with all the different volatile moves and swings that we've seen. This came out to 1.35% per month for the 9-month period, remember. We just did it from the beginning of January to September 1st. 29 total trades, average return on the winners close to the expected of 2.8%, but the losses of 4.2%, those 4 times out of 29, brought down the expectations. In 2019, upward market, 16% average VIX, we only saw a 5.6% return over the 12-month period, or 0.47%. Let's call it 0.5%. Success rate we wanted, 80%. An average return, though, of only 1.6% on the winners, volatility taking its toll, and the average loss on the losers was only 2.9% because, again, there was less volatility. We didn't see as high of a return. Then we go into 2017, where the volatility was much lower. We tried that 10% out of the money screen, looking for a minimum return of around 1% to 1.5% or higher, and we only made 4 trades. Only 4 trades matched that search criteria in the backtest. So he did average 2.9% return over that 8 to 9 month period in 2017 from essentially February or March into the end of the year. But since there were only 4 trades, the average return over that time period just came out to 1.8% per month. Using no return, we do see a better outcome in 2017 for 10% of the money, but it's only 7% or 0.58 per month. We're missing the targets of the 1 to 2% with these strategies. We do have a 93% success rate, do average 1.4% on the winners, but over the time, some of those losses, as small as they were, negated the gains. The 7%, all still profitable, just like the 10%. The 7% out of the money, we had a $53,009 from starting at $50,000. It's only 6% per month, or 0.75. Remember, that's for that 9-month period. Terrible success rate of 61% with the fluctuations in the market. The average win was the 3% we were looking for, but again, with that success rate, you're not going to meet the targets and your goals. Essentially, in 2019, the picks of the day is essentially the 7% out of the money range, and this gave us a 17.4% return over the 12-month period, 1.5% per month in the wheelhouse of 1 to 2%, with an 88% success rate. In 2017, not nearly as good. The success rate was pretty low, only about 0.1% per month, 64% success rate. And the average return on the winners was only 2%, and the average loss on the losers was 2.9%. Now let's take a look at the more aggressives, the 5% out of the money and the benefit of the stops. In 2022, with a low success rate of 57%, because of the higher average win, we did come close to the 10% out of the money range return. Instead of about 1.4 or 1.35% per month, we're at 1.3% per month. Again, 10.3% return over that 8-month period from January to September. Taking out the stop for 2022 still resulted in a positive return of 7.5%, around 0.94 per month. Success rate increased to 68%. The average win moved up to 4.5%, but the average losses tripled to minus 6.2%. That's why the end profit was lower of using a stop versus not using a stop. Same thing in 2019. We had a negative return going 5% out of the money with only a 58% win rate. Average return on the winner was close to the 3%, 2.6%. But again, a success rate under 70% is not going to help you reach your target goals. Well, did see that in 2022, the benefit of volatility. But in a lower volatile market, you're going to need to be right with these out-of-the-money naked puts or in-the-money covered calls. closer to 70% or more. Again, we take out the stop for 2019, same criteria, 5% out of the money. The loss increases slightly. It's now a loss of 2.2% or 0.18% per month. The success rate jumps to 82%. We only have 9 losses. The average return on the winners stays at 2.6%, but now the average loss on the losers, even though it's only 9 compared to 21, triples up to about 14.4%, and that takes out more of the portfolio. And even in 2017, going 5% out of the money, more aggressive, looking for a higher expected return, we see a loss of 2.7% or 0.23% per month over the entire portfolio. 63% success rate, lower volatility. The average return on the winners is only 1.8%. Average loss on the losers, minus 3.9%, similar to what we saw in 2019, but with a lower return because lower volatility in that 11 to 12% range. Lastly, just as a comparison, the SPYs. This helps us illustrate the benefits and curses of volatility. In 2022, average volatility of around 25 or so, starting with $50,000 over that 9-month period, it would have dropped down to $48,359, a loss of 3.3%. 9 total trades made, makes sense, right? 67% success rate, only 6 winners and 3 losses. Average return on the winner was 1.3%, and the average return on the losers was 4.6%. 2019, average volatility of around 16. Just 1 month out, 5% out of the money or so, SPY, 1 trade per month, we would have gone up to $52,684, a 5.4% return or 0.45 per month. Not in the 1 to 2% range, but again, it's not what you expect with SPY. 100% success rate, 13 out of 13 trades successful, and an average return on the winner, 4 or 5% out of the money, of only 0.6% return. Whereas on those more volatile stock positions or general security positions, even in 2019 and 2017, we are seeing an average return on winners of 2.6, 2.5, and 1.4 later on for the 5% out of the money range. 2017, average volatility around 12, still 100% success rate. Unfortunately, only 7 trades were made instead of the 12 or 13 because the quarterlies caught me, so it missed about 2 cycles essentially. But in any case, still a profit, 2.1%, 0.26% per month, with an average return of the winners of 0.3%. That gives you an important little reference that when volatility across the market is roughly around 25 or so, we'd expect a return of 1.3%. We cut that down to an average volatility of 16%, and the return is cut in half essentially to 0.6%. And in a year with a 100% success rate of an average volatility of only around 12 or so, maybe 11.5 to 12, it gets cut in half again to only 0.3%, even with a 100% success rate. The double-edged sword, kind of the market conditions we wanted for a success rate, not seeing the returns because the volatility is too low. Now, some brief thoughts. It is interesting that only out of the money naked put approaches it lost were the 5% out of the money approaches, even in 2019 and 2017, during upward trends, and the 5% out of the money naked put approach in the tumultuous 2022. Though we did not always see excellent returns, and we did not see maybe the target we were looking for, the 10% out of the money and 7% out of the monies were all profitable, with the highest return being the tested through the various iterations monthly naked put picks of the day for 2019 in the upward market with the good average volatility of around 16%. But again, where is that 3% monthly return? Isn't that what this is all about? Well, our goals for this presentation, and let me know later if you feel we achieved these goals or not, were to show why we say those making 1 to 2% per month with conservative income strategies, which was the highest polled strategies being used, are not settling for low profits, they are succeeding. To showcase that if you set your targets too high, being too aggressive, you might end up with a much lower profit outcome than expected, even in upward markets, due to the number of losses of that aggressive approach. Even though the patented PowerOptions search tools will find your desired returns in an option strategy, you might not see the desired outcomes based on the structure. In addition to move with the market, also know the market. Returns expected range out of the money for what we saw in 2022, maybe even 2021 or 2020. Naked puts, covered calls, even credit or debit spreads would not have led to many or any results being found in those lower volatility markets. That is essential because Max R's question was 3% potential return using option strategies in all market conditions. As we know, not all market conditions are the same, so you have to move with the market, but also know the market that you're in. Did also give us a chance to illustrate the pros and cons of a stop versus no stop. That although when we took the stop out for some of those 5% and 7% screens, we increased the success rate, sometimes significantly, but the overall return was lower because the losses now started to outpace the expected gains. And to reiterate, move with the market from part 1, but also know the market here in part 2. Are there tools available for those structures? Absolutely. On PowerOptions, the tools to help you move with the market, patented search tools for bullish, bearish, and neutral strategies. Picks of the day that have been thoroughly tested, weekly bull puts and weekly bear calls are preferred approach in the right market conditions. Portfolio tools to track, manage, set alerts, and evaluate rollout opportunities. In this example, we didn't roll the positions out. We simply closed them when the stop was hit, or closed them for the max loss if there was no stop. But that's where the power of the portfolio tools come in. You may be able to adjust and roll, and of course, turn a losing trade into a winning trade, provided the market gives you that opportunity. And that's what the rollout opportunities will show you. And of course, the market sentiment tool for warnings of market shift or potential change in the market. Tools to know the market. Well, the search tool is only going to show you positions that match your criteria and sentiment. And again, reiterating something about the default searches. Most default searches, including the picks of the day, have been back tested for a good starting point. In neutral to bullish strategies, we're looking at positions that are in the trend we want, above their 20-day, 50-day moving average. We're not bottom feeding on these positions. We're looking for things that have shown success over time. And again, in the target range that's expected for those conservative income strategies or even other strategies that you might consider using. Credit spreads, debit spreads, calendars, and more. Detailed research tool for the stock and for the options to see the volatility, implied volatility range, and much more. Analysis tools, the custom spread tool, profit and loss chart, Black-Scholes calculators to run what-if scenarios and even comparisons against other positions. And there's also an optionable stock statistics page, which gives you the average across the entire market for things such as 20-day volatility, 50-day volatility, other stock criteria as well. So you get a broad market overview to know the market and the current conditions. And of course, so much more. Remember, at any time you can take a no risk, no credit card required 14-day free trial. Just go to powerop.com and put in your name and email address. You'll have full use of the site for 14 days, the tools to move with the market, the tools to know the market, and so much more.